The other thing that I'd add, though, is that there's an interesting market dynamic where I would say tokens right now are lagging the equities that are launching, which I think further drives this dynamic to play out, in that liquid investors in crypto should be open to investing in crypto equities in the same way they should be interested in investing in tokens, in theory. And so these are close to direct substitutes for one another. And so for every high quality company that launches a public equity, some percentage of capital that would otherwise potentially buy tokens is now questioning whether this is a better opportunity than tokens. And so I think it increases the bar for the token market as well, in that now there are these liquid substitutes that retail investors have the ability to get exposure to.
What's up, guys? Just wanted to give a quick shout out to today's sponsor, Aptos. We'll hear more about how Bitcoin, DeFi, and Aptos is heating up later today. But for now, let's get into the episode. Nothing said on 0x Research is a recommendation to buy or sell securities or tokens. This podcast is for informational purposes only, and any views expressed by anyone on the show are solely our opinions, not financial advice. Boccaccio, Ryan, and our guests may hold positions in the companies, funds, or projects discussed.
All right, everyone, welcome back to another episode of 0x Research. We are doing it live from Permissionless, joined today by Felipe and Noah of Theia, and it's a pleasure to have you guys on. How are we doing today, fellas?
Good. Thank you for having us on.
Yeah, likewise.
Yeah, awesome. How are the vibes of the conference? Feeling good? This is day 3, so we've got 2 days under the belt.
Yeah, it's great. I can't complain. I'm a New York native, and I'm a big fan of Industry City, so it was great to see that it's out here.
It's been great. I mean, the whole year has been conferences in New York. We our travel budget decreased by 90% this year, so we're pretty happy about that.
Yeah,
too.
there we go.
Wow.
Just to Uber over.
Yeah,
Yeah.
You're not the first
doubt.
person to say this as well. It's New York is back.
New York is back in a big way.
So how are we feeling about markets? I know you guys are a crypto fund, but obviously macro plays a massive impact here. We'd love to get your takes on the broader macro environment and where you're kind of thinking about where we're at.
Yeah, so I guess I'll start with like general macro, which I have less of an inclination about, and then can get into crypto macro, which I think I have more informed perspective on. But I think like general macro, crypto right now is heavily correlated to what I would call like retail equity markets. So the ARK indices would be the best example. There's about like an 80% correlation coefficient. And so right now, those equities are doing quite well. They're outperforming the market. And so I think the same is directly true for some of the crypto equities. And I'd imagine that makes its way into the crypto markets as well. So that's one piece. The second piece is that right now you have like M2 money supply, which is another like big correlation for Bitcoin at new all-time highs and continuing to go up. And so as long as you don't have anything break from increasing money supply, that being either interest rates or currency weakness like the dollar, I think that's probably the continued trend that we're going to see is more fiscal stimulus from various world governments, which probably continues to support Bitcoin on a relative basis. So that's some of the foray into macro. And then on crypto macro, I think you have stablecoins at all-time highs, Onchain borrow at all-time highs. Volumes aren't quite at the all-time highs just because Q4 of last year was quite an exciting period for meme coins, but certainly what I would call like higher quality, longer term KPIs are moving in the right directions. The only thing I'll add on top of that is that while you have stablecoins at all-time highs and you have borrow at all-time highs, the actual on-chain interest rates are in a very different environment from Q4, where in Q4 you had interest rates going up to 15% in some cases, like the basis was a very large trade. Today, on-chain rates for like blue chip USDC money markets are closer to 4%. And so that provides like a different revenue opportunity for on-chain lending. It also has a number of follow-on effects as far as like how traders are interacting in markets.
Why are rates different today?
I don't want to index to previous cycles because it's a low sample size, but it isn't too dissimilar from 2022, where people were less focused on reaching for upside. So you didn't see like leverage buyers willing to take 10 to 15% interest, but people are interested in collecting yield. And so demand to lend has increased very materially. Demand to borrow has from higher interest rate activities has come down. But there is a lot of activity on like looping from yield sensitive funds. And so they're much more yield sensitive. And so naturally rates just don't elevate as much as they used to, or at least today that's the case.
Yeah, they used to go crazy.
Yeah.
They used to go nuts.
I mean, they might again.
They're
It's just
very
there's a lot of
subdued now.
there's a lot of stable coins on chain, and although there's a lot of borrow demand, there still is a lot of stable coins that have to find a place to find yield.
Right, and so that they should push. I mean, like if you see a flood of stablecoins coming in before the demand, you could actually see the yield profile get worse, right?
Yeah.
Yes, which is what we're seeing right now. I
Yeah.
think where like
Yeah,
yields
yeah.
continue to compress because there's continuous demand for
Yep.
stablecoin yield.
Yep. Yeah, exactly. And the big bull case for I think a lot of the stablecoin activity is that like, oh, stables will come because the rates are higher on chain, but like you're actually not seeing that. It's an interesting little wrinkle.
Well, it's like, what are we going to get? We're going to get high yield environments where you can park cash and get a good return, or you're going to get a low borrow. Like you can kind of pitch it either way, which is interesting.
Yeah, I think we need to whenever the on-chain interest rates go below U.S. Treasury rates, I think the question just becomes, why aren't people willing to borrow to arbitrage the rates? And I think that's naturally a function of what existing on-chain borrow lend protocols allow you to do. But if you have opportunities that yield higher rates and can allow for arbitrage, then I would imagine on-chain rates shouldn't be able to go materially below U.S. Treasuries. So I think like as the borrow opportunities expand, as these protocols onboard more collateral options, we'll see less of yield falling below risk-free rates. But at least today, it's a bit of a interesting dynamic.
Yeah, and on the dampened volatility side, we're also seeing like a tech improvement, if you will, right? So Spark, for example, is they manage a lot of the USDC in their ecosystem through MakerDAO, or now Sky, right? And you're seeing them really dampen the volatility on the Morpho pool that does has the Coinbase integration, right? So directly from the app, Coinbase users can borrow against their Bitcoin, and then Spark will basically provide the liquidity there on the borrow side with the USDC and really do a good job of balancing it out. So anytime there's increased demand, they'll just deposit more and keep that flat rate. And you've seen really good progress towards dampening the volatility in that rate, which is better for the borrowers as well.
Yeah.
So I think we're seeing, again, like on that's more of like that technological improvement or efficiency improvement from the crypto side.
Yeah, or market structure improvement.
Yeah.
And I guess the Morpho case is interesting because that's like real exogenous demand that we didn't have before. People who'd never borrowed on chain before using that feature, right? Because Coinbase is reaching them through distribution. If you get enough exogenous demand, then this could change and rates could go up, right? It's just you're not like, last time I saw that there was a 300 million. It's meaningful, but it's not that large relative to the amount of capital on chain. If all of a sudden you start getting 30 billion of exogenous demand, then you really get an opportunity to bring more stablecoins on chain at higher yields.
Do you think there's any demand for more like fixed rate lending? I know Morpho is trying this with their next iteration. I don't know, it's maybe the V2. I think they're referring to it as sort of like an intent-based system where, hey, I want to borrow this size at this rate, and you can get to match someone peer-to-peer on the other side. I think there's any demand for that. I know there's like teams like Term Labs that have kind of tried this or experimented with it. Similarly, we've seen people experiment with the under collateralized lending as well to varying degrees of success. But I'm curious if you have any thoughts on the fixed rate side.
Yeah, and I think the demand is proven out also by Maple, right?
Mm-hmm.
They are doing primarily fixed rate loans, and they've been growing quite aggressively over the past 6 months. In large part because a lot of funds need fixed rates to be able to execute strategies or plan strategies. So I think that the reason there hasn't been fixed rate on chain is more, there's some demand issue, right? Funds primarily that want this, sophisticated investors that want fixed rate, but also the mechanism hasn't really been there for it to work appropriately. Basically, whenever yield curves are inverted because rates are very high in the near term, people want to borrow fixed rate if they're planning out a longer term strategy, right? And then also, it does become really difficult to eke out these like levered 15% just on the dot strategies with a variable rate, because it can, your strategy that worked today and you underwrote and took to IC might not work tomorrow, and that's not really tenable for a lot of more sophisticated investors.
Mm.
Are any is it all funds that are borrowing from Maple, or are there like a business getting a loan? Are they doing any kind of that activity?
It's mostly funds. I would say it's a mixture of directional funds looking for leverage, yield funds, just optimizing for various costs of capital. And
Yep.
to a lesser extent, I believe that there are probably Bitcoin miners or companies that have like crypto collateral that need loans that are borrowing, but probably a much smaller percent versus the funds that are using Maple today.
Yeah, still the crypto economy.
Bitcoin DeFi is heating up on Aptos. With nearly 400 million BTC assets on chain, Aptos users can now earn yield on their Bitcoin via Eco aBTC and OKX xBTC without the typical bridge risks and high fees. To explore BTC yield opportunities on Aptos, follow the link in today's show notes.
As always, investments in blockchain technology involve risk. Terms and conditions apply. Do your own research.
There's been a lot of chatter on the crypto equity side of things. I'm curious if you guys have any views on there. Obviously, Robinhood, Coinbase have been, kind of the talk of the town. When Circle IPO broke the internet for a few days as well. That was pretty funny to see the S1 get released, and then everyone on crypto Twitter have nothing but negative things to say about how the business is being run. And then it goes live, and Wall Street loves it, and it hits like an 8x. It's going to be interesting to see who's next in the IPO lane. But yeah, curious if you see any major trends there, maybe around the treasury companies as well. Yeah, what are your general thoughts on crypto equities?
Yeah, there's a lot happening in crypto equity. So one trend is that there were a lot of growth companies that raised in 2021 that haven't raised subsequent rounds. And in 2023 or 2024, their secondaries were trading at sometimes 75 to 90% discounts from those rounds. And what we've seen from 2021 to the trough until now is that now these businesses are much closer to their high watermark and have a path to liquidity, where the funds that invested 4 years ago might be approaching end of fund life. And so a lot of these growth companies are looking for ways to enter the US equity market, whether it's a IPO or a reverse merger. And so we've seen a few of those. I know that there are more that have submitted prospectuses, and I imagine that trend continues, especially given how well Circle has traded on the back of the IPO. The other thing that I'd add, though, is that there's an interesting market dynamic where I would say tokens right now are lagging the equities that are launching, which I think further drives this dynamic to play out, in that liquid investors in crypto should be open to investing in crypto equities in the same way they should be interested in investing in tokens, in theory. And so these are close to direct substitutes for one another. And so for every high quality company that launches a public equity, some percentage of capital that would otherwise potentially buy tokens is now questioning whether this is a better opportunity than tokens. And so I think it increases the bar for the token market as well, in that now there are these liquid substitutes that retail investors have the ability to get exposure to.
Which is appropriate, right? Because you can't have, the problem we had for a while is that there was a lot of trapped capital in token markets or VC markets. So the people were comparing opportunities to other opportunities in that space that they're investing in, and not really looking at the entire realm of assets and saying, is this better than a PE deal? Is this better than a real estate deal? And to the extent that equity markets start to, open up to crypto investors, crypto capital, then equity markets already compete between themselves for capital. If you bridge that link with crypto funds, it raises the bar for tokens, but in a healthy way, right? It helps token founders understand, a lot around transparency and disclosures, which we've talked about ad nauseum in the past, but also in terms of what you need to offer investors in terms of cash back and multiple on your money for it to be an appropriate return. It's a healthy process for token markets. But,
a couple other things that I'd bring up on this topic. So on Circle, one thing that I've seen that's interesting, although I guess not surprising, is that a lot of people are focused on fundamentally justifying what's happening on Circle price and assuming that what's happening is somehow related to something fundamental. And I think that on one hand there is some part of that's true, but I would say that's not what's actually going on. And that Circle is talking about raising in between, call it on the low end 5 and on the high end 8 billion. That was the general range that was being approached. Naturally, they were able to raise on the high end when they went public. The equity traded at a premium to that and went up materially from there, to the point where Circle, the equity, traded at parity with USDC outstanding. Now you can paint this case that USDC is going to grow materially. They're under monetizing partially because of potentially negative regulation. And there are a lot of different ways that they could potentially grow into this valuation. But if I had to opine on what actually is happening, it's a similar dynamic to low float, high FDV, not in a nefarious way, but in that when an IPO is created, there are locked shares, and if the float is low enough and there is a high enough thematic interest, Circle being a stablecoin pure play, there will be funds and retail investors that have capital that they're willing to deploy into it. It's not because they're building out a DCF and saying this is something that I could justify. It's either because this is an interesting theme that they want exposure to, or because they think that the next X number of days price action will be positive and therefore it's positive expected value to invest. And so I think while Circle is probably going to continue to trade higher than the IPO range, fair value is almost certainly not at 60 billion.
Yeah, my mental model for what happened there is day one, it was a combination of retail and funds who wanted to get exposure before the quarter was up. I know June 30th was some time away, but I think that's still on folks' mind. And but I think from that day on, from day 2 to now, I think it was people on Robinhood and their Robinhood app smashing by. I can't imagine that other than being a trader, like a fund would underwrite Circle at that number.
I agree.
It's tough, right? All the regulatory news coming out of DC is more openness to new stablecoin issuers.
Yeah.
Right? And these things are going to be really, really liquid between themselves. Like
Yeah.
liquidity matters at 100 million. You're fully liquid at $1 billion, 5 billion, 10 billion between stablecoins.
Yeah.
So probably what's going to happen in the market is we're going to see a lot more issuers over the next 4 years. Some of them with really good distribution by themselves, right? Any bank has really good distribution.
Yep.
Any Robinhood, Coinbase. I mean, Coinbase obviously is allied with Circle, but any platform like that will have good distribution. So they won't have these massive distribution expenses you see with Circle, where they're paying, Coinbase a big percentage of revenue. And just more supply will come online to
Yep.
compete with Circle as an equity. And I would imagine that, it doesn't hold up.
Yeah, like the Circle and Coinbase were beneficiaries of the regulatory environment, right?
Yeah.
Like people didn't want to compete with them, and now it's like, yeah, go for it.
And Tether.
And Tether.
Yeah.
Correct. Yeah. So interesting. We'll see what happens.
Yeah, the Tether one's interesting. I was chatting with someone today. He's like, I was recently in Buenos Aires, and everybody's still using USDT on Tron. Like that's what it is.
Yeah,
and it's
cool.
like you always get these anecdotes, but now we got Tron trying to go public as well. So getting into more of the crypto equity side. But Noah, you mentioned the overlap between how big is the gap really between trading tokens and trading equities. I think we're seeing that tighten as well, right? Like Robinhood obviously offers both to their users. We're starting to see the tokenization of equities become an increasingly interesting idea, right? You've seen Superstate announce that they're trying to do this. There was recently something, I think it was totally a Republic was trying to bring secondaries onto Solana recently. You've seen the same kind of thing happen on L2s, right? There's backed already live with tokenized coin on Base. Do you think that's like an interesting trend, or is it mostly just noise? Like, I'm just curious to kind of think, like, what's the end result of, do we need equities on chain?
I guess it depends what type of equities, because I'd argue that we have existing equities on chain today, but I'll put that aside. I think that cross listings are interesting for if you believe that there are emerging market buyers that want access to U.S. equities that wouldn't otherwise be able to set up traditional brokerage accounts. As far as for funds and U.S. investors that already have the ability to get exposure, I think the interest in tokenizing equities is more so on de novo tokenization. So taking a private company that might not have a clear path to going public, but deserves to have a liquid traded instrument and wants to do it at a lower cost than the requirements would be to register on the NYSE. I think that has validity. So I think it just depends on what type of equity we're talking about bringing on chain, but certainly in the cross-listing side, existing public equities, there's an emerging market angle, and then in the new equity issuance side, it's I think a cost savings play.
Is the emerging market thing exciting to you? Emerging market folks buying U.S. equities? It to me, it seems like it's not a needle mover. It might there might be a winner. I think the outcome in market cap terms will be small, but like I don't know.
Well, it depends on
The
whether
big
you're
money
thinking
has
about
access already, right?
the big money has access. I guess there's a large amount of people in emerging markets. Kind of 5 billion plus people. So it depends on how much of that decides to buy. But like the TAM is big in terms of the number of people. It's not going to be that exciting for volume. I think the most exciting thing for volume we've ever seen and will see is meme coins, because they have the highest turnover of any token or stock or asset. But it could be meaningful on TVL, right? The numbers that we're looking at on chain for TVL are tiny, still in the single-digit basis points of world assets. So if you get people in EM buying Nasdaq or S&P or Apple, that could be a big amount of TVL relative to what we have on chain now, just because we're starting at such a small base. But it won't trade, and if it trades, it won't pay 1%.
Yeah.
I think the other thing that I'd add is that there is a composability play to tokenized equities, and that in theory, at least today, if you want leverage against your equity, you're reliant on your broker and whatever policies they have structured, and that's a walled garden. Essentially, your broker has custody of the underlying asset, you have an account with them. But naturally, there are a lot of different open source money markets on chain, and so if they allow for leverage against specific equities, then there's now a competitive market environment where they have to compete on the required yields. So I think that there probably are benefits long term that come from like some of the composability and like using these assets in DeFi rails, but it's a bit less clear to me today on how long it will take before we get there and see mass adoption of those types of things.
Yeah, the volume point is really salient to me because if you look at Superstate's T-bill fund that they have right now, right, the way it works is you can whitelist a handful of addresses that you can transfer the asset to. And a couple of those are lending markets, but there is very intentionally no exchanges on there because they can't allow for the transfer of these assets due to regulation. And so that doesn't feel like it's getting unblocked anytime soon. And then to me, it's like, okay, Metatrend, equities coming on chain. Who are the winners? It doesn't feel like the DEXs are in that category. Like you might need more specialized service providers that come on chain and kind of facilitate the trading of this, which wouldn't really be a beneficiary for any of the DEXs that are live today, let's say. Whereas the lending markets that exist today, it's still a little bit interesting, right? Because they can actually take these in, onboard them. They can handle the liquidation with whitelisted liquidators and things of this nature. Yeah, curious if that trend like resonates with you guys.
Definitely, and the DEXs are also starting from a really, really high point. I think at the peak with Trump, the DEX volumes were like 20% of Nasdaq for a few days. That's a lot. Right, and again on TVL, just to bring that point back, we're in single-digit basis points to the kind of equivalent, right? Like global financial assets. So DEXs are just starting at a very high base. Like a lot of the trading that happens worldwide does happen on-chain already because, again, meme coins are so high turnover. Very little of the asset ownership that happens worldwide happens on-chain. And just one point on the EM side, I think for stablecoins it will be really significant. Right, and I think this point's been made many times, but like the total amount of available holding demand for US dollars worldwide is huge, and it's a severe problem for people. So if you could see above $1 trillion of stablecoins held by EM on chain. If any of that really flows into assets, it's meaningful, right?
Seems like a huge political problem.
It will be for the local countries that are used to. And you guys know how this works, right? Like if you hold pesos, like you're not able to hold dollars.
Yep.
The one way to do that is to make it illegal. One way is to make it like a, 5-day swap window with a 15% fee.
Yeah.
You're just not going to do it.
Then you use USDT on Tron.
Yeah, that's what Argentinians are doing, right? Yeah. And as soon as you can use it to pay for your US, if you have a virtual bank account and you can pay for your digital goods with US tech companies, it starts to become really attractive, right?
Yeah, and so there was two branches there. One was, actually, before we get there, so if the exposure thing is all you want, so less on the stablecoin side, right? You actually need the asset to use it for transporting your wealth through time or actually paying for goods. But on the equity side, if the exposure is all we're trying to do, then it doesn't feel like actually, wrapping these assets, bringing them on chain, bringing in the custom service providers to facilitate the trading of these things. Like, that's a lot that needs to go on versus like, slap an Oracle on there and do it on a perps DEX. Now you get your exposure. All you needed was the Oracle integration, and away you go. I'm curious if you think the actual wrapping of the asset needs to even happen, if all we're trying to do is get people exposure.
I understand the heart of the question, and I agree that in certain circumstances, derivatives are an easier way to get exposure versus spot assets, and that's true for most markets. But if you're thinking about longer term positioning, like taking a 10-year view on the S&P 500, doing it via derivatives is incredibly capital inefficient, and you're taking a lot of unknown risk on, for example, what is the basis rate that you're paying to hold this position open. And then you also have custodian risk with whoever you have the perps open with. So I think it just depends on the exact use case. But if you want to speculate on shorter term price movements, then most of the time I'd imagine that perps are more efficient for that.
That makes sense.
And credit risk on the pool, right?
Yeah.
Because there's no way to hold, unless you wrap the asset, you're always taking credit risk on the pool, at least in capped gains. But at most in the pool just blowing up.
With nearly 400 million BTC on chain, supported by a secure, fast, and affordable Move VM environment, Aptos has become the BTCFi growth chain. Aptos users can now earn yield on their Bitcoin via Eco's aBTC and OKX's xBTC without the typical bridge risks and high fees. With support from Echo, OKX, and Stacks' SBTC, Aptos is the place to go for best-in-class yield on Bitcoin. To explore BTC yield opportunities on Aptos, follow the link in today's show notes.
As always, investments in blockchain technology involve risk. Terms and conditions apply. Do your own research.
So to rewind a little bit to the what type of equity is coming on chain, you mentioned how you have this company that deserves to have the liquid instrument that might not be ready for an IPO in traditional capital markets. What is the relationship there? Like, if you can IPO, especially following the Circle IPO, it feels like, okay, then that's the direction I want to be going as a crypto company. But what's the pitch for launching on chain? Like, why would I go that route instead of trying to go to the traditional capital markets?
Well, I would agree that if it's a choice, like I can register my company via the NYSE, the choice to go on chain today is harder to make. If there is no choice, I have no ability to register, then it's more so a function of, do I want liquidity or do I not want liquidity? But I would just say, like, right now it's hard, or we're kind of in like the cold start problem where like the market structure that needs to be built out for on-chain equities to work is like, right now there are a few hundred liquid funds, so certainly they could be the net buyers of these equities. But we need exchanges that can support equity, whereas on-chain DEXs today, putting aside whatever regulation changes, generally aren't made to support securities. And then you probably need some type of KYC around this, and you probably also need like market makers. So I think as the infrastructure on-chain builds itself up, it's less of a lift to argue like why launch on-chain versus why launch on public equities, but that's not the case today. So putting that aside, the argument that I would give for if you have access to the NYSE, why you would launch on a different venue is probably going to come down to cost. And I think that's probably the only reason, in that registering and meeting disclosure frameworks that the NYSE has, it's what I would consider to be one of the most stringent exchanges. And so the cost to complying is in the tens of millions per year. And so that works if you're $1 billion+ company and you value liquidity of being on the NYSE. If you want, you don't need that same liquidity, or a smaller company and don't want to have like the cost associated with $10 million a year, then you'd consider going either to OTC markets today or perhaps on-chain. And I think on-chain right now, I'd imagine the costs are closer to $1 million annually, give or take, but I defer to Superstate on that specifically.
But it's all, I mean, now we're getting to the realm of more speculative, because this is not happening today, really,
Right.
in a big way. But like, our mental model for all this is just underserved markets versus overserved markets. So like, who is well served by the current, public market infrastructure? Big U.S. companies. There's fewer than 10,000 of them, right? Like that can actually IPO and be on what you consider a legitimate market, right? Like not OTC markets. That's a very small percentage of the world's companies, right? And so who's underserved by that system? Definitely EM companies, if they can prove that they have, if they can get over all the legal issues, that they can access more deeper capital markets. And then potentially US mid-market companies or small cap companies that cannot afford to go on chain is an underserved market. Like whether or not they will decide to do it, we'll see, but they're underserved by the current system. So that's where my mind goes in terms of answering your question. Like who wants this?
That's a good point about the EM side of things.
And I think the forcing function is probably liquidity. Like right now, the private markets, very broadly speaking, developed markets are a bit unhealthy in that the bid-ask spread of a lot of private companies is very wide. And the time for companies to exit after being invested in by venture investors and private equity investors continues to expand. And simultaneously, a much larger percent of equity markets have moved to the private markets over the past 20 years. And so right now, I think it's hard to make an argument about why the market structure may shift, because right now there isn't an illiquidity discount, which historically there is, and that like if you have a company that trades privately, it's going to trade a slight discount if it were to trade publicly. But if that illiquidity discount comes back, then I think the justification for going public is very clear. And then you get into the question of what is the composition of these private companies today? What percentage of them are too small to consider going public on the NYSE? And I think that's actually probably a pretty large pool of companies.
Feels like there's an opportunity here, right? Like, think about like everybody used to register businesses in Delaware, and they had all the infrastructure you needed. To your point about kind of cutting costs and getting all that infrastructure in place, if you were in EM economy and you kind of saw the trend shifting here, it'd be pretty interesting to try to position yourself of like, hey, if you do want to take this shorter, quicker path to market, come launch here. We'll take care of all the infrastructure for you. We've already built out a lot of this. We've got the market maker relationships. We've got the ATS built on chain that's got the liquidity figured out, and kind of be that hotspot for how you get these businesses on chain.
Yeah, it's a big opportunity. We'll see. Hopefully, the U.S. does it, right? Because then you have a lot of the world's companies, and then you just consume more and more of the global financial system.
Feels like they have all the reason in the world not to be a first mover there. There is the if you're in the existing traditional financial system, you're gonna fight tooth and nail to like not have that happen because you collect that $10 billion a year.
Yeah, the companies will. I guess the thing is you do always need. So I agree that on the opportunity, you do always need the local country to agree to this. It's not like stablecoins. Stablecoins is kind of no agreement needed from the local country because you just hold your stablecoin and that's it. If an Argentinian company is going on chain, you need the repo layer, right? The repossession layer to agree to that. Otherwise, they can just rug the token. And then if you have a local business, local hotel, like and the country doesn't want to enforce the token rights, it's just the easiest rug in the world, right? Because it's not a digital business. It's not an on-chain business.
That's a good point.
It's purely physical. So I agree there's an opportunity, but you'll never be able to do it without the consent of each country one by one, which is why I like the U.S. because it's the biggest market,
right. Kind
of the leader, people follow. Could maybe one day enforce rights for others, but
That's a really interesting angle. And on the kind of disclosure and transparency front, I don't want to talk too much about this, but Felipe, I know we spent a lot of time, and all four of us, honestly, thinking about how do we bring a little bit of this into crypto. You have to thread this strange needle of like, okay, you have like full gap accounting, you've got the full disclosure regime enforced by the SEC. They're like, it's a law, you have to do this. It's not an option. How can we bring some layer of that into crypto to shed a new light into the off-chain pieces of these protocols, right? Everything on-chain, we actually do a pretty good job as an industry. Masari was very early to these quarterly reports of getting teams to just communicate outwards. There's a lot of great data providers doing work to pull that financial data off-chain, from the chain and communicate it outwards. But the problem is there's a huge opportunity for crime on everything that happens off-chain. So your entity structure, how the foundation's set up, who owns and controls the tokens, and how if those wallets are actually disclosed to the public. a million different areas. But one of the goals that we wanted was like, okay, this is only useful if funds and retail can use this in their due diligence process, right? If it's not, then we've kind of like missed on the framework. We're not asking the right criteria. I'm curious, it's only been a week and we only have 5 projects live, but from your perspective as a fund, like, have you guys been able to think about this in a new light as you're doing due diligence on projects? And like, do you think we've kind of achieved that goal of making something useful for somebody like you?
For us, it's been pretty useful already. So we actually sold 2 positions based on the framework.
Wow.
I think we sent it around to all our companies. They were, for the most part, eager and enthusiastic to fill it all out. We do a lot of diligence to begin with. Like, it's a very important part of our process. Obviously, how much we think about token holder rights. And even then, the framework was comprehensive enough where we saw 2 companies be a bit squeamish about filling everything out. That, that kind of signals blood in the water. You start to pull on that thread, and then you find out that maybe something's happening that's okay for other people, but not okay for us. And then I think, for us, disrespecting the token holder relationship is a red line. So we just kind of immediately sold. And I think other people will do the same thing. It's one thing for people to tell you on a diligence call, that XYZ is true. It's another thing for them to put it out into the world publicly in front of everybody. And as funds see the disparity, they see like, hey, you filled this out, but it doesn't say, line 15 doesn't say what you told me. I think funds will start to punish tokens that are behaving even a little bit nefariously or maybe behaving in the old way. Let's put it that way.
Yeah, and I think that's like what a lot of we've seen in the industry is the lack of disclosure itself is not inherently a bad thing, but it creates the ability for bad actors to profit off of ambiguity, right? The ability to profit off of not ever being asked the question.
Yeah.
And I think that's kind of how we can bring in that first wave of just getting off zero.
Or lying on calls, right? Because people don't.
How often is that? Where someone will tell you one thing and then you check the chain or do some reference checks and find otherwise.
It happens too much. Like, I don't know. I don't want to give a percentage. It happens too much. I think part of it is, the last regulatory regime was so counterproductive because by classifying the whole industry as kind of infested with fraud and full of bad actors and all the things that Gary used to say, it really let those people shine, right? Because there was no, you're prosecuting Coinbase and Uniswap, good actors, or at least the best actors in the industry, and everybody else kind of gets a green light to do whatever they want, right? Because it doesn't matter how you act. It's just by nature of being in the industry that you'll be in trouble. And then you'll be in the same troubles as everybody else. And what you really need is some way to differentiate, right, or dissect who's acting well and who's not acting well. And that's what we're doing, that's what we're seeing now. I think the token transparency framework will go a long way in doing that. But that's a roundabout. People are more comfortable lying than I would have expected coming from TradFi.
Interesting. And have you seen a shift in quality over the years of, you'd want to see the industry has matured a lot, obviously over the last couple of years, even what feels like the last 6 months. Do you think that will kind of trend away as more serious people come into the space to build more serious products and you see less of the like science project turned $1 billion market cap token?
I think the industry's been maturing a lot. I was surprised by where we were when I started. Like, I thought it was better and it was way worse than I thought, but I'm definitely not disappointed by the slope of maturity, right? Like, I mean, you guys have been instrumental in this. Like, even revenue used to be a controversial idea.
Couldn't get it.
What? Couldn't get it.
Yeah,
so that's like,
and why would you want it?
that's like a 0 out of 10, right? Yeah. But
people
then now,
love selling $1 for 50 cents.
Yeah. So that's
zero.
out. Like, people now, I think, for the most part, understand revenue and cash flow.
Yep.
Transparency and governance, I think, are on the way, getting better. A lot of the teams that are left are good, right? Like, a lot of people who were true scammers or mercenaries and not that focused on the industry were the people who were lower quality.
Yep.
So to the extent that it's been a tough, 4 years, they've been leaving for easier get rich quick, pastures, and that's good. So the people who are left are really good. So I'm pretty, and then now, now the industry is being given a little bit of a cloak of acceptability by the government, which is really important. The one
It
thing
legitimizes it.
the one thing I'd like to see is I'd like to see AI founder, same profile versus crypto founder on Hinge or a dating app, and see like percentage hits over time, because I think that actually drives
That's
the number.
the real market signal right
It's
here.
I mean I think it drives the number of entrepreneurs, right? Like you guys all experienced it, like going to a wedding or something. What do you do? Work in crypto? Oh,
Financial media company every time.
Oh, nice. Yeah, I would just dead eye crypto, and like
You're a better man than me.
That's been changing over time, right? Like when it's been getting better since stablecoins and Genius Hacked and all that. And I think that will drive the number of entrepreneurs coming in a way that matters.
All right, we need a line plot of your interactions every time you say that.
Yeah, exactly.
see
Eye contact seconds after.
Exactly. Yeah. Sorry, I need to go grab a drink. I'll be right back. Okay. No, that's good to hear. I mean, yeah. So on the transparency side of things, we have huge demand that came in. So we only launched a week ago. There's already more than 50 projects that are waiting in the wings. So we're trying to move through this. We're going to launch another cohort next week. And that's kind of to your point about the good people are the ones that are still around. It does feel pretty true. Because like I said, the demand was way higher than I would have expected, right? Jason kind of put out a joke tweet the week before we launched and was like, we're launching something next week. Half the industry is going to love us. Half the industry is going to hate us. I thought maybe the 50-50 was a little bit facetious, but I thought more people would be upset. Like, I don't know. One, you launch a new thing, people just love to complain. But two, you're still like, I don't know. Like I think the mantra "sunlight's the best disinfectant" is really true. But there's a little bit of pain, right? You get burned a little bit. And I think honestly, people were the overwhelming support that we got. I think was a really good testament to how big of a problem this was. And the solution is pretty obvious, to be fair. It's like, hey, we just need to ask people to answer the questions. But then building out the team, getting everything running is more of the operational side of the problem. But yeah, we're super excited. I think things are definitely trending in the right direction.
Well, the 100 companies that did not apply don't know they're going to get sold, but they'll figure it out soon enough.
Well, I hope more people think like you as well, right? Like it should be a little bit of and you talked about the lemon market talk, obviously, with it's now live from Research Day. Check it out on YouTube, 100% recommend. But you talked a lot about the ability to produce the credible signal. And hopefully this does service that in early innings, but it does feel like it's actually achieving that. But yeah, I really do hope it gets positioned like that by the market.
Yeah, I think so too. I think maybe one plug on the market maturity is what is still a big issue is the HR bottleneck. Like there are not enough good people in the industry. I don't mean good ethically. I mean good like in terms of competence. Mm-hmm. I like the people who are in the industry. I think a lot of them are good, but we just need more founders, more investors, more people pursuing yield strategies. Like it is really hard to find, and you all know this. You guys are recruiting, right, constantly. It's hard to find quality people. I think my mental model for when to join an industry is kind of opportunity over competition. Like how much opportunity is there left versus how competitive is it? That's kind of why I left my buyout job. There was not that much opportunity left. It was good enough, but there was a lot of competition. 1,000 top business school grads a year competing in that market. It is the opposite here. There's a lot of opportunity. There are maybe a few hundred aggressive, really competent people. So if you're not in the industry, you're probably not watching this, but if you are, you should come in.
Yeah, no, I totally agree. That was kind of my thought process on why I was excited about jumping into the industry as well. And got it through a Twitter DM, so you never know. It's a weird industry, and we love it.
It's a good famous story.
Yeah.
You DM Yano.
Yeah.
AlgoKit 3.0 includes all the tools and open source resources you need to unleash the power and performance of the Algorand blockchain. Access a resilient network with instant finality, consistently high throughput and low fees, and layer 1 features like atomic swaps and native assets. No smart contracts required. Whether you're building DeFi protocols, enterprise solutions, or next-gen dApps, AlgoKit has all the tools you'll need to build faster, safer, and smarter. Start building with AlgoKit today by following the link in today's show notes. As always, investments in blockchain technology involve risk. Terms and conditions apply. Do your own research.
All right, one more interesting trend here. So passionate listeners are probably tired of me talking about this, but I've been thinking about how centralized exchanges came on chain over the years, right? So you had Binance, who was first, 2019, launched in 01. Coinbase comes second around 2022, a little bit more lightweight. You launched the L2. A little bit less infrastructure, though. Coinbase engineering team probably disagrees with me. The amount of work they put in is very impressive, and they've really been accelerating the performance of the OP stack. But then you see more recently Bybit's announcement of going very lightweight. Forget the chain. We're just going to launch a set of smart contracts on Solana, and our core mission is to facilitate the trading of assets, and this will help us achieve that. And so you kind of seen almost the reverse trend than what I would intuitively expect, right? You start off super lightweight, and over time, as you scale, you try to own more of the stack. But we saw the exact opposite happen. I think a lot of that has to do with rewind to 2019, and if you really wanted to put an exchange on chain, Ethereum was the only option, and like the performance was never going to work. So you didn't really have an option. So I think that has a lot to do with this versus now. Solana is performing very well, and so Bybit was probably like, hey, like why bother go do all the infrastructure necessary? Like let's just throw some contracts on chain. I've been trying to think about, okay, so that's the trend we saw with the centralized exchanges. But what about like the banks of the world, the asset managers? Like what is their approach going to be? And we've seen like a very mixed bag, to be honest. Right, JP Morgan has Connexus, but it's more of like this private infrastructure-focused chain that they use just to facilitate some like repo activity that kind of just makes their life easier on the back end. Now they've announced the stablecoin-like asset that they're going to launch on Base, so doing a little bit of both there. And I think the argument for why you'd probably want some of these larger banks could be like launch their own chain and actually own the full stack is because they do have the distribution engine. They've got the Web 2 facing platform where all of the users already are, right? So they can just kind of plug the chain in, boom, there you go. You don't even need to bootstrap an ecosystem, which as we know can take north of 2 years. But I'm curious how you think about like what's that landscape going to look like, right? I think everyone's kind of anticipating the Robinhood announcement at ETHCC, which will be next week. What are they going to do? I think a lot of people think chain. I don't really know if they're going to go more of this Bybit, very lightweight route. Just curious to get your general thoughts on how people are going to come on chain, and is it going to be with your own chain, sort of this like many chain thesis, or is it like, look, we got like activity is going to coalesce around a handful of chains, like let's just plug in there?
It's an indirect answer, but I think that the North Star is pragmatism relative to how our industry has kind of been a bit more idealistic, in that like if you have distribution, Robinhood, for example, it would make sense to create a walled garden in order to like monetize as best that you can. If you don't have distribution, then there's a bigger question. But like the thing that I'd emphasize today is that like there's a lot of path dependency in that, like on chain today, if we're talking about purely like DeFi users, I think that there's probably about 20,000 daily active users. It might be 50,000, but it's not 100,000 with reasonable confidence. And so for a bank that's worth tens of billions of dollars, the opportunity of capturing those users isn't as clear as continuing to monetize their existing user base. And so I'd imagine that a lot of the interactions banks and other regulated financial institutions have on chain is going to be those that somehow benefit the user experience. And then I'll caveat by saying that I do think that there is some like value of announcements are being attached to like the crypto and stablecoin narrative. And so I'd imagine that a lot of financial institutions will do something on chain as like a starting point, but I don't think it's going to be a commercial opportunity. I think it's more so going to be like a pilot program or proof of concept that may or may not find substantial traction.
Announcement Fi.
Yeah.
My favorite.
We have like a minute. So, do we want to talk more about announcement Fi or?
No. Whatever you guys want. I wanted to hear Noah talk about the treasury strategies.
Yeah, let's hear it.
Yeah.
What are your thoughts on the treasury
quick hot
strategies?
takes on treasuries on treasury strategies?
Yeah, I think like from the perspective of the people that are engaging in them, it makes total sense. Like the companies that are engaging in a lot of it's companies that otherwise are in financial trouble. So like small cap public companies, call it 20 million market caps with NYSE listings, that probably are losing a lot of money. So if this is a way for them to raise money, it solves a goal that they probably have. On the other side, the funds that are contributing to these deals, a lot of the like structure is downside, I get my Bitcoin, Ether, whatever it is back, maybe give or take like 5%, and upside, this asset trades at a material premium to NAV that I can eventually exit. And so that's also an interesting like risk reward structure. But I think what's missed is where the reward comes from, in that the game that's being played, whether it's understood by the people that are playing it or not, is that when a raise is announced, the equity of the raise, or the equity associated with the raise, goes up materially, call it 100+%. In an upside case, some of them just haven't performed well after that announcement. And now you have a material premium to NAV, and now you have potentially a bunch of unsophisticated retail investors that trade equities that see that there is this asset attached to crypto and just think, I'm going to buy. And so the return on the downside, whenever the investors unlock and the price kind of compresses back towards NAV, whatever the premium is to NAV is probably a function of the percent of capital from unsophisticated retail investors that's depositing at a material premium to NAV. And so I think, one, it's not a sustainable trend because it relies on essentially taking money from retail. But the second thing is that a lot of people hopped onto this trend because they saw success or initial success of a few of these treasury deals, putting aside MicroStrategy. And the confusion that I have is that none of these deals have proven to actually be successful from a distribution perspective, and that a lot of deals, although they trade at material premiums to NAV, the shares that people bought in the raise aren't unlocked. And we've now had a few examples where the first of these companies have had their unlocks, and lo and behold, they trade right back down to NAV, and people move on to the next one. And so I actually don't think that these strategies work at scale, and I'd imagine that the amount of capital that's already been deposited has gotten past the point that these strategies can scale. It's just a question of how long until all of them unlock and you see the investors try to exit, and then we kind of play the game of picking them up at a discount to NAV, if I had to guess.
How many more months do we have?
So a lot of pipes are structured as 6-month locks. Convertibles, there's a lot more variance, but I'd ballpark 6 months is kind of how long it takes from, if they started in April, I'd imagine Q4, a lot of them are going to be in a tough position if they weren't already in a tough position because they had unlocks before then.
How has Saylor done such a good job of avoiding this problem? He seems to have mastered the financial engineering playbook too.
I think he was first, and that makes a very material difference.
Yep.
I think he also had a real business, not to argue over business quality, but the business justified a high enough market cap where he could raise serious capital behind it and kind of bootstrap this treasury. So I think part of it's path dependent. It's hard to say why it happened, but if I had to point to it, it's probably large existing company traded on the NYSE, first to do it.
All right, last question on this, then we can wrap it up. But we saw it go pretty right tail pretty quick. Even BitTensor got one of these things. Are we going to see more of this? Where's the Fartcoin version of this?
I think so, but then we get into a question of investor protections. Because I think this goes on until people get burnt in some form or another, or the trade dies. And so I think right now, what I'd imagine will eventually happen is that you have tokens that have poor liquidity or have lockups associated with them, whereas the equities that trade on NYSE are very liquid. And so investors can deposit tokens that are perhaps illiquid or locked and now get a liquid instrument to exit with. And so that's a appealing structure for those investors. And so I'd imagine some of those vehicles will come to market. But I think that the Bitcoin, Ethereum, Solana, there have been enough of those that all have their kind of marquee treasury strategy on the NYSE where you can't come to market with that and expect it to be able to raise well. So I think you have to start going into the tail opportunities.
I think the interesting thing about Noah's view is we all know they're not going to work long term, right? Kind of baked into the premise, but people might not make so much actual money on them either. It's a little bit like the infra coins where we all knew it was a game and it was kind of a way for funds to make money, but they didn't end up making much, DPI on them because by the time that they were able to sell, the game was up. And I think that might happen, in this with this.
Sort of like a self-healing problem then.
Yeah, it might just be money in, money out. We'll see.
Well, awesome, guys. It's been a fantastic conversation. Where can the people find more about you guys?
Twitter. So I'm at Theia Research.
I'm at Trader Noah.
There we go. We'll put that links to that in the show notes. But this was a pleasure. Appreciate you guys.
Thanks for having us on.
Thanks for having us on. Always a pleasure.